Hello and welcome to eOptions webinar. We're excited to have you here and thank you for taking the time out of your day to join us. We partnered with the Options Industry Council, or OIC today, to bring you this webinar today on volatility analysis for options investors. My name is Gina Bocayas and I'm with Regal Securities, the parent company of eOption and InvestTrade. And to give you some housekeeping items of the webinar, the session today will last approximately 1 hour. Our speaker will talk for 40 to 45 minutes, and then you'll have a chance to get your questions answered. And if you have any questions during the webinar presentation, please feel free to type them into the question box on your screen, and our speaker will answer those at the end of his presentation. We ask that you don't enter questions in the chat room if you'd like them answered by the speaker, as he won't see them. You can also reach out to our trade desk at any time if you have additional questions after the webinar. And for those of you just joining, we'd like to welcome you to our webinar today on volatility analysis for options investors. And to tell you a little bit about our company, as our name eOption implies, we're a brokerage firm that specializes in stock and options trading. Our founder was one of the founding members of the Chicago Board Options Exchange and has been an active option and stock trader for over 40 years. He created his ideal trading company that caters to serious traders. And we have some of the lowest rates in the industry. All stocks and ETFs are commission free and options are just 10 cents per contract plus $1.99 per trade. I'd like to turn our attention to our speaker now, Ed Madla from the Options Industry Council. Ed has over 20 years of experience in the financial industry. He started his career with Hull Trading Company, where he was an options market maker at the Chicago Board Options Exchange and the Chicago Mercantile Exchange. He then spent many years as an independent trader of stocks, options, and futures. He then went on to MF Global and went into the futures brokerage business and then joined RJ O'Brien. In 2014, he joined the Options Industry Council, where he is today. He's currently the Director of Business Development at OIC, where he oversees retail education programs. He also has a lead position in the production of options curriculum for the OIC. Without further ado, I'll turn it over to Ed Madla. Thank you.
Thank you very much, Gina, for the introduction. And as Gina said, my entire career in industry has centered around options one way or another. I really enjoy what I'm doing right now. We have actually undergone a bit of a organizational structure with the change in job titles. So there's a little bit more visibility on OCC, the clearing corporation that owns and provides OIC. So a little bit of a structural change there within our corporate entity, but all we do is education. This is what OIC is all about. And the team that I work with, my colleagues, are all former traders and brokers. Today's discussion, again, all educational. It'll be about volatility. What is it? What are some analytics? How does it affect options pricing? A lot that we'll get to today. First, our disclaimer. Options are not suitable for everyone. They are a rather complex investment tool that needs to be well understood before using them in a live account. And here's how the outline is going to look. First of all, with definitions, examples, just to clarify what volatility is, historical versus implied, the Greek known as vega, and then historical implied volatility. This is a term that I don't think is as widespread. I like to use this term, historical implied, when you're trying to evaluate what do these current levels look like? What am I supposed to do with them? Historical implied is the term I like to use, along with a few analytical pieces of data that you might be able to find useful to you. And look at some classic strategies. A few of the strategies that are pure volatility plays. We'll wrap up the session today with a look at a few of those. First, I want to clarify volatility overall, in general, does not represent direction at all. It simply reflects fluctuations in the stock price, either way, up or down. It doesn't really matter where you start or where you finish. It's all about what happens in between. Two different stocks here that start and finish in the same spot. One of them has more volatility, one has less, simply because of all the action in between. In fact, you can also have a stock that starts, as I draw it in here, at the same spot and finishes at a different spot, and still, this red line that I just popped in there would still be less volatile than this black line stock that's all over the place, up and down, and finishes this time period unchanged. The key takeaway is that volatility measures fluctuations, changes in prices over a given time frame, and does not represent direction at all. We're going to focus our attention mostly on two different types of volatility. First of all, historical volatility. What is that? It is a stock price's volatility in the past. It can be observed, quantified, it's factual and not a prediction. Given today's level, you can look back at what the stock has already done and calculate what type of volatility have we witnessed in the share price over that time frame. Investors can choose for themselves what kind of time frame they're most interested in. It could be the last 10 days of stock price movements, the last 30 days, the last 90 days. You can choose for yourself. I most often hear the 30-day historical volatility measure being used. What that will do is look back at the previous 30 days of trading, calculate the historical, factual stock price volatility level, and then track the 30-day number. With each passing day, the oldest day drops off, and a new day gets added into that sequence of 30 days, and it gets tracked over time so you can see if it's going up, down, or sideways. Looking back, it's factual, that's historical volatility. As an example, if you have a stock that has already seen a measured historic volatility of 15%, we'll compare that to a few others. Certainly the stock with the lowest volatility level of these three is going to have the most observations near the mean price and the shortest or more narrow range from bottom to top. And then you have on the other end, say stock C with the highest level of observed historical volatility, the least amount of observations near the mean, the widest range top to bottom. That's what volatility will calculate. Now, we're interested as options traders in the future, not necessarily the past. Historical volatility is a measure that we can use to help interpret what we think might occur moving forward. But always remember, options are priced based on expectations between today and expiration date. Historic volatility has its place, but is not going to be the only measure. For example, given these numbers, if stock C, for example, had earnings announced last week or the week before, and that's what triggered some volatility, and it's now starting to settle down. And let's say, for example, stock A has earnings coming up on the calendar over the next week or so. And so the stock has been sort of settling into a range waiting for that announcement. If we were to price options contracts looking forward, we very well might be using a higher volatility assumption for stock A than we would be for stock C. Historic volatility would play a role, but also knowing what's upcoming, looking at the calendar and judging what type of future volatility might we see in the share price for whatever reason is all going to be priced into the options contracts. If you were in that circumstance and you're wondering, well, how would you price volatility if earnings was upcoming next week? All we know is historic volatility has been 15% recently. So how do you do that? Well, one of the techniques that investors and traders might use is to reference past instances of earnings announcements and see what kind of movements have we witnessed in the stock price for previous earnings events, and use that information to guide how big of an event is this particular earnings announcement. Maybe it's being perceived as by the investing public to be a bigger event, or maybe not as big as previous earnings announcements. All of that information will be contained within the options price. As a market maker on the floor in the beginning of my career, well, this is something I had to do all the time. And when you first start pricing in implied volatility, for example, a new expiration date that comes on the board, it needs an implied volatility level. You're using all of this information, the historical volatility of the stock, previous levels of how the stock has moved after earnings. You're looking at the calendar. At the end of the day, you're trying to merge all of this information, and the more uncertain you are, the wider your markets become. And that's a little more of a market dynamic of bid and offer. If we were not so sure, not too comfortable with the implied volatility assumptions that we started with when a new listing came on the board, markets were a little bit wider. Our bid ask was a little wider until we started to see what direction is the order flow coming? Are there buyers coming in? Are there sellers coming in? If one direction was dominant, then implied volatility levels changed. And if there were buyers and sellers, we started to feel more comfortable, then the markets gradually started to tighten and our bid asks were much, much better. It's always a forecast, but historical levels are looking back. I've already somewhat defined what implied volatility is. This is the term that is specific to options contracts. Implied volatility by definition is the volatility assumption at which the option is currently priced in the market. Let's think about the options pricing models. You have inputs on one side of a pricing model as you're trying to calculate a theoretical value for a call or a put option. You enter in the stock price, the strike price, the days to expiration. You have to enter in an implied volatility assumption. And then if there are any dividends, risk-free interest rates, you add all of those inputs, go into the pricing model, and then the output is a theoretical options price. And what we'll get to a few times as we walk through this segment on implied volatility is that often implied volatility is solved for. So just as you can assume a level of volatility and calculate the options price, you can do it the other direction. Observe an options price and back solve for what volatility level justifies that options price. Ultimately, options prices are determined by anybody and everybody that is putting in bids and offers. Theoretical values and hypothetical values, they have their place and they help some trading firms, some investors who have an opinion on where volatility should be. They help them interpret what a fair market value for the option should be, but ultimately anyone who's putting in market orders, every market participant, that's you, me, that's banks, that's institutions, it's everybody, is going to drive an options price. And if you think about that back solve explanation for implied volatility, as option prices go higher, it drives implied vol levels higher along with them. If there's more sellers in the market, driving options prices lower, in turn, the implied volatilities will then be lowered. When I was trained to be a market maker, I was trained very early on to let the market tell me where implied volatility should be. I wasn't trained originally in this business to make money off of having an opinion on what direction the market was going or what direction implied volatility was going to move. I was making money off of the spread of the bid ask, off of capturing what we called an edge between the bid and the offer. And I let the options market tell me where implied vol should be. If there were more buyers coming in, I raised implied vol. Didn't have any opinion on whether or not that should be the case, but there are more buyers and sellers, so I let it happen. If there were more sellers coming into the trading pit, more order flow on that side of the trade, I lowered implied volatility assumptions. I let the market tell me. And ultimately for professionals, for many professionals in the business, that's the direction it works, is observing option prices and letting implied vol get solved from there. Just as we said, historical volatility is looking backwards from today at what the stock price has already done. Implied volatility tries to look forward and will incorporate historical volatility into its analysis of where should these levels be, but also look at the earnings calendar, look at what's upcoming, anything that's on a micro or macro level that can move the markets or move the stock price will go into the calculation for implied volatility, and ultimately that comes from supply and demand. Now, each strike price has its own volatility level. Pricing models had suggested you put in all the inputs, your output is the options price. That clearly indicates we're talking about a specific option. Each strike price has its own volatility level. If you were to draw a chart, which I'll attempt to do here, if you were to draw a chart and plot implied volatility levels with respect to, say, the strike price, given a certain expiration date, and then connect the dots across all strike prices. Most often, the classic curve that you would result with is going to look something like this, with your at-the-money strike being somewhere around here. And this is the classic volatility skew or volatility curve that you may or may not be familiar with. The lower strike prices have higher implied volatility levels. And as you go higher in strike, levels come down and they settle at their lowest level just above the at-the-money strike where they bottom out. And then there's sort of a drift higher before they tail off a bit. This is mostly because put options are used for protection. Investors and money managers are protecting extreme downside moves, which also improves their cost of capital, and are often willing to pay small amounts of money, dime, a quarter, a $50, $1, even for far out of the money puts. Prices that, based on an implied volatility assumption, would look to be too expensive, too much. But for that small dollar amount, they can protect against huge, fast, quick moves and quick sell-offs in the market. And oftentimes market participants are doing that. And that's why you see these low strike prices with very high implied volatility levels. And that probably also corresponds to very low or relatively low dollar amounts, premium amounts, where money managers deem it worthwhile to still buy those options, even though they're far out of the money and implied vol is higher. Now, this is the classic skew. Given a particular stock, the skew can look far different. Now, this is what you would expect to see with an index, but the skew can look any way that a stock it happens to be trading at the time. For example, this year in 2020, many symbols saw inverted skews. That might look a bit odd, strange. It was a unique circumstance, but lower volatility in put strikes, higher volatility in call strikes. And you probably are familiar with many of these symbols as the market rallied through the summer and fall, stocks that were just going higher and setting sometimes all-time highs, if not significant near-term highs, where the options market had its skew flipped. And all of the interest, all of the demand was on capturing this upside and buying calls. And there was not too much concern to buy downside puts. And then you had this inverted skew. A bit of an interesting dynamic that we've seen, and I've seen this year more so than any other year that I can remember, inverted skews. But normally those inverted skews eventually come back into line. You can also have flat skews where the volatility assumption on the downside and upside is the same. I think the most classic example of this is in the commodity markets, where you might have underlyings that are priced off of gold, silver, or oil, or others, where the perception of the speed or magnitude of the move, higher or lower, can be equal, can be the same. There isn't a necessity to protect one side more extensively than the other, and then you might have a more flat volatility skew or curve. So these skews can take all sorts of shapes and sizes, but the classic shape that you would expect to see most often in equities and certainly in the index options is going to be this skew with high vols at low strikes, followed by bottoming out just above at the money before tailing off. I'm going to refer to this skew again, so just keep it in mind as we move forward. But now to compare the two, implied volatility for all sorts of reasons can be at great variance with a stock's historical volatility level. And expected implied volatility to change will happen all the time. The changes in implied vol are going to happen constantly. And as I had suggested when I was on the trading floor as a market maker, it was the most significant part of my job throughout the day. It was not just to make markets and trade as often as I could and capture edge and be on both sides of the market, but to observe what direction had more order flow, the buy side or the sell side. And I was constantly changing implied volatility levels throughout the day, every single day as that order flow is coming in. That doesn't necessarily mean moving the whole curve. I'll just go back a slide because I'm going to refer to it again. If this was the way the curve looks, well, the whole curve can go up or down, meaning that you have implied volatility levels across the board going up or down, where you have this, say it moves up to here or it moves down to here. You can have the entire curve shifting up or down, or more commonly for me on the trading floor was to actually move a particular area of the curve. So I would click and drag, not literally, but basically click and drag this part of the curve higher or lower to change values at those strikes, or move this part of the curve. If there were buyers coming in for 40, 35 delta calls, and there was just a lot of demand there, all of a sudden I can move this part of the curve higher at these strikes and change the values, change the bids and offers that I was going to have to reflect the order flow coming into the trading pits. So it doesn't require a change in stock price. It's really dependent on order flow. Where are the bids and offers coming from, and what direction, more specifically on the buy side or the sell side? It's often asked, will the implied volatility return to historical volatility? It certainly could. Some investors will make trades assuming that it will, but it may or may not. There could be new normals set for whatever reason. You could have a different business structure. You could have a different industry changes, micro level changes, macro levels. All sorts of things can happen to a firm or an industry that change the way it operates and potentially change the way volatility behaves in the future compared to its past. But either way, whatever happens with implied volatility, it is very difficult to predict, but it certainly can expect, you can expect if you notice an option price change that doesn't seem quite right to you, then implied volatility is generally the reason why that's the case. And again, when we say, well, implied volatility changed, what that really means is there, for whatever reason, there were more buyers that came into the market, or there were more sellers that came into the market, all else equal. Let's look at these numbers and what they mean. I'm not going to spend a whole lot of time on the numbers you see, but I just want to let you know what does that percentage of implied volatility represent. And I'm also going to walk through verbally something that might be more useful to you, which is known as the rule of 16. But first, what we have here, we have the stock trading at $80 and annualized 30% implied volatility. So what does that actually mean in numeric form? It's that we can expect the stock price to stay with a deviation of 80, which is 30%. Here it is, $24. Statistically, within one standard deviation, or $24 given 80 times 30%. And here's your expected range, 68% of the time. Then you have 2 standard deviations, 3 standard deviations. You can see how wide these ranges get. That comes from the stock price times the volatility level, and that represents 1 standard deviation move. Now, I don't think a whole lot of investors use this analysis, at least that's the feedback I get, because of how wide these ranges can get. it's hard to interpret or form an opinion one way or the other. But the rule of 16 is used in maybe a more relevant way. Very simply, the rule of 16 takes the implied volatility level and divides it by 16, and the result is the expected single day expected stock price move. So an implied vol of, say, 32%, you do the quick math, 32 divided by 16, that level of implied volatility is suggesting a 2% move on average moving forward for each day. And if you're curious about the math, I'm not a mathematician, but the limited amount that I know about that is that implied volatility is a function of, or volatility in general is a function of the square root of time, not time itself, the square root of time, and the square root of the number of days in a trading year is roughly 16. 252 trading days divided, or a square root of that is just about 16, and that's where that number comes from. Implied vol divided by 16, and there's your expected daily stock price move. Then you can evaluate from there. If you think that seems high to you or seems low to you, and remember, that's an average. Stock certainly can move less than that sometimes and more than that other times. It can move in either direction, up 2% one day, down 2% the next day. It's back to where it started, but that still is 2% each day. Remember, it doesn't represent a direction and would be calculated as an average. But the rule is a rule of 16, and we use that on the trading floor quite a bit to get a snapshot of what implied volatility was meaning. Now, it goes without saying that as implied volatility increases, moving forward, the expected range of stock prices would increase, and that would drive both call and put prices higher. As implied volatility decreases, then the expected potential future range of stock prices, top to bottom, would shrink. It would get smaller, and that would drive down both call and put prices. Also, changes in implied volatility are more magnified for longer dated options. Think about that through a more extreme example. If there was only one day to go, or even more extreme, there's only 1 hour to go until expiration, and you moved implied volatility up by 1%, that's not going to do anything for those out of the money options. With only an hour left, if you raise implied vol by 1%, you're still not going to get any changes in value for your out of the money options. But if you were going out 1 year and you raised implied vol by 1% over that entire time frame, that range of potential prices has definitely changed, and you will see an adjustment to your option values. Longer term, you'll see implied vol have a greater effect. The magnitude of the effect given an implied vol change is certainly valuable information to have, and that is the Greek known as vega. It is an option value's sensitivity to volatility changes. Given a 1% change in implied volatility, how much might this options contract value change? And that's what vega represents in decimal form, a cash amount per option. And as I really just said before, as implied vol goes up, you would expect option values to increase by the vega amount, and as implied volatility goes down, you would expect the option value to decrease by the vega amount. This is a huge driver of options premium. You have to remember that changes in implied volatility often occur by far more than just this 1%. When you're seeing your vega number, keep that in mind. What if there's a 3%, 5%, or 10% change in implied volatility levels? What might that mean? All else equal. This is where I think an options calculator can be handy and useful. We've got one on our website at optionseducation.org. You can go there into our calculators section and input everything you need to input into the pricing model. Calculate an options price and then start to change the implied vol levels, leave everything else the same, and move implied vol from, say, 20% to 25 to 30 down to 15, move it all over the place and see what kind of effect that has on the theoretical value of your options contracts. It's a good way to start to get a level of respect for how important implied volatility and its changes are. Let's look at a few of those changes and through an example. Buy an XYZ DS50 call for $3 and you have a couple months to go, and here you have a stock fluctuating for whatever news. Maybe you had a rumor come out, that rumor gets removed and the stock moves around but settles back at 50. If you just woke up and missed the entire trading day, you'd think the stock was unchanged, nothing happened. I lost some small amount of value in time decay here, but you look on your screen and you see the DS50 call has gone up to 340. And what has happened? Implied volatility has increased, and that is likely due to some kind of event or new information that has come into the market that has driven more buyers of these call options. Maybe more buyers for all the options on this stock, but maybe more buyers of call options to the upside. More buyers means option prices are going to go up. Market makers aren't just going to keep selling at the same level. They're going to increase those prices, and that drives implied vol higher, and you would have an unrealized profit just simply from implied volatility going higher. The most prominent circumstance when volatility changes is earnings. I think everyone is probably familiar with what's known as the volatility crush. After an earnings announcement, volatility is likely to come down significantly because the news, which was perceived to have driven uncertainty, is now known. That news has been revealed. So implied volatility comes down. Option buyers are aware of that, and they are hoping or expecting that the move in the stock price is going to more than compensate for that loss that they will experience due to volatility coming down. A lot of people are familiar with that, but what is a little bit less intuitive is what happens right before earnings. You might notice often that implied volatility starts to increase on the days or maybe even the last week or two before an earnings announcement. And you might think, well, couldn't I capitalize on that? If implied vol tends to go higher the week leading up to earnings, couldn't I buy options a week before earnings and then sell them a day before earnings and profit from that increase in implied volatility? And the answer is, well, certainly it's possible, but let's think back to the pricing models. You are inputting everything on one side: stock price, strike price, days to expiration, implied vol, dividends, interest rates, and you're getting an options value. Think about all of those numbers. If everything is staying the same, except you start to drop the days to expiration, while the option value is staying the same, the only way that equation is going to work is if implied volatility goes higher. Without the option value going higher, it stays the same. Implied volatility goes higher because days are coming out. And you do often see that leading up to earnings. Buyers tend to hold their bids. They certainly might bid options to higher values. That might be the case, and you could profit if you were long. But they might just be holding their values leading into earnings. And sellers might be less interested in lowering their offer prices leading into earnings. And because of that, implied volatility is going higher. Again, it goes back to that definition of justifying an options price given the other parameters. Let's look at a put option, and I used a calculator to get this by looking back at some of the changes in implied vol that we had witnessed and seen this year in March and April. I'm just getting a sense for what kind of premiums do you get at different levels of implied volatility. Stock price at 60, just looking at a slightly out of the money put option strike, 59 with a month left. If implied volatility was at 20%, this option would be trading for roughly $1. That would be the theoretical expectation for where this option would be trading at. if you changed implied vol to say 30%, this is one example of the type of changes we saw just because of the market activity back in March and April. 30% moves this option value up to 180, but there were some stocks who saw much larger changes in implied vol, 50%, not unrealistic when you get market corrections. You can just see the difference, $3.30. Everything else is the same. Stocks at 60, strikes 59, 30 days left. At these different levels of implied vol, these are the different premium amounts that you can estimate or roughly guess that the option might be trading at. And now I'm going to give the same sort of explanation when it comes to put options as they approach expiration. I said earlier when I was drawing the volatility skew that put options tend to hold their bids because money managers and investors have an interest in holding or buying cheap put options for protection in case there's a huge correction. And again, it also improves their margin requirements and cost of capital. Put options also tend to hold their bids as expiration approaches, especially when they get to very cheap amounts, that dime, nickel, quarter premium amounts, they tend to hold their bids. So if days to expiration are decreasing and we're getting close to the expiration date, and this option has been trading for a quarter every single day, the only way that math works is implied volatility goes higher. This is another dynamic you might notice, is that the implied volatility of puts tends to increase, or that skew that I drew earlier tends to steepen as you approach expiration, because not many investors are interested in selling put options for a quarter or a nickel or a dime. Those option values tend to hold. That means implied volatility increases. Does not necessarily mean that the prices themselves are going higher. One of the more difficult questions when it comes to implied volatility is trying to figure out, how do I interpret it? How do I know what to do with it? And that's where a couple of metrics that might not be the easiest things to find, but just to show you that they're out there. What is implied vol rank? What's implied vol percentile? These are a few rather simple attempts to characterize implied volatility levels. Implied vol rank, for example, compares the current implied vol level to a range over a defined time frame. That's usually 1 year, given, say, for example, an observed range of 20 to 60%. A current implied vol level of 40% would give you an I-vol rank of 50%. It's right in the middle. And if you followed that, if the current level implied vol was 30%, we're 25% up from the bottom here. You're 20 to 30 is 10, this range is 40, so it's 25%. The implied vol rank there would be 25%. It's 25% off the low towards the high. And just to further showcase that example, if the time frame is 1 year, it often is, an I-vol rank of 0% means the current level is the lowest of the year. The current level was 20%, the I-vol rank would be 0. And 100% means it's the highest level, and that's I-vol rank. It doesn't consider all of the observations within the time period. It just looks at the low, the high, and the current level. That's in contrast to I-vol percentile, which would show you the percentage of days that implied vol has been lower than the current level of implied vol. If the percentile is 60%, it means the previous levels have been below the current level 60% of the time. Percentile does look at all of the observations and shows you how often has implied vol been lower than it is today. There are two different metrics. Investors, sometimes look at one or the other, or a little bit of both. They tell you slightly different things. They're also very simple to calculate. You can do this yourself just by tracking on paper implied vol over time and coming up with these calculations and these numbers yourself, or maybe just even a better analysis yourself by looking at implied vol each day as you're tracking your particular stock or a particular option. That was one of the advantages I felt like we had on the trading floor, was we traded the same stock, the same options on the same underlying every single day, all day long. And that was one of the advantages we had, was that intimate level of familiarity with the underlying and with implied vol levels. Both of these are an attempt to capitalize on what I'm calling historical implied volatility, tracking implied vol over time, looking back at it and mapping out the historical levels of implied volatility, and then comparing that to itself, its current levels. How do current levels compare to past levels of implied? How do they compare to the historical volatility of the stock that we talked about at the beginning? And then developing some sort of opinion. If the current level is higher or lower, what does that mean? The next question is it going to revert back towards the long-term average? You have to answer that question. If you think it will, then the next question is, what kind of a trade are you going to execute? When I was trading volatility professionally, and for a period of time, that's all I did was trade volatility. This was the analysis. How does current levels compare to past levels? If there is a deviation, is there a good reason for it? Is it going to come back to its mean? And if so, what trade do you want to execute? And that's where I'm going to finish up. I'm not going to spend a whole lot of time, but just the classic volatility strategies. If you just want to trade volatility, that's all you're doing. Trading implied vol levels. The most classic strategy is going to be the straddle, which traditionally involves using at-the-money options. In this case, look at the long straddle, buy the 87.5 call, buy the 87.5 put with the stock trading there. Current share price 87.5. You buy both of them, and you have a net debit of both options. So now you have, you can hopefully clearly see this is a pure volatility trade. You need stock movement either lower, higher, doesn't matter which direction. You just need a movement in the stock to a magnitude at which you can overcome the cost of the straddle, either direction. This is also the strategy and the price that is often used if you hear economists or you hear someone on TV saying that the options market is predicting a certain percentage movement in the stock to occur after its earnings announcement. They're likely looking at the straddle and calculating what's the straddle price versus the strike price. In this case, $4 versus 87.5. The options market is suggesting at least a $4 move needs to occur before profitability to the upside and lower than that if you're selling this. So $4 divided by 87.5 puts you somewhere just under 5%. So based on a binary event, let's say today's Tuesday, we have earnings coming out on Wednesday, and these options expire on Friday. So the nearest expiration to the binary event, take a look at the straddle price, $4, stocks at 87.5. So there you say, based on the options market, we would expect about a 5%, somewhere just less than 5% move in the stock after this particular earnings announcement, or the options market is predicting. This is, I think, like a 4.5% move. And that's where that number comes from that you might often hear. Now, a sister trade to that, a very close cousin trade, is the strangle. Again, buying options on both sides, a call and a put. But instead of paying more to buy the same strike, you just go out. You buy the higher strike call, you buy lower strike puts, you're using out of the money options here, paying for both. And similarly, you have profitability potential in either direction, and it needs to be of a certain magnitude, lower cost, lower max loss, but wider break-even points. That's what you give up to achieve a little bit better risk profile. Just to compare these two strategies to each other and also show the short versions, straddles will have higher premiums. Those are, again, you're at the monies because you want no delta to begin with. You're asking, why would you choose at the money versus, say, an out of the money straddle? Well, you want to start with no delta, zero delta, and that's going to be your at the money call, your at the money put. Higher premiums there, your break-even points are going to be a little more favorable. With strangles, they're going to cost less, and break-even points are farther apart. And with respect to these short versions, most oftentimes investors are not comfortable with the amount of risk that you see here on both sides of this. Some investors may be okay with it, but oftentimes they're not. So the short straddle is often turned into an iron butterfly that would be buying a put and buying a call somewhere outside for protection on both sides. So the short straddle is an interesting strategy to understand, even if you don't like the risk profile, because you can turn it into an iron butterfly. And the short strangle, similarly, many of you may already know that by buying a put down here and by buying a call up here to protect from all of that potential risk, you have turned the short strangle into an iron condor. And that is a very popular strategy that option sellers like to use. For buyers, this is a classic difference between buyers and sellers. Buyers know that time decay is working against them and implied volatility moves that are going to be lower, contractions in implied volatility are working against them, and buyers need the movement in the stock to be to such a great extent that they can overcome that. Sellers want time decay working in their favor, and they are hoping or predicting that the movement in the stock price is going to be less significant, and the time premium that they're able to capture with respect to decay is going to be more significant than anything they might have to give up with the stock price movement, all the while knowing implied volatility changes for sellers. Implied vol goes higher, that works against them, and if implied vol goes lower, that works in their favor. Pretty big differences there between buyers and sellers. And we'll get to your questions here now, and while I do, I will put up our contact information. If you want to look for more information, here we are, optionseducation.org, podcasts, videos, webinars, and you can take advantage of our service desk free of charge. We don't charge for anything we do. We're just an industry resource. So take advantage of all that. If you have options related questions, you can send them to options@vocc.com. And that's what I had for you today. I hope you enjoyed it. Hope you found some useful information here today. And Gina, I will turn it to you to wrap it up.
Thanks, Ed. We have a few questions. I don't know if you had a chance to see those. If you have a few moments to address those.
Sure. Let's see. Well, the first one is, I think that's a comment. How can we make big option money? Well, that's the question I think we are all always asking ourselves. I will give the responsible answer there, which is do your due diligence, analyze the market, form an opinion that you are comfortable with, and then it's a matter of choosing the right strategy. It's not always going to be an options trade. Sometimes the stock trade is the way to go, but if you have an opinion, you've developed that opinion in a responsible way, you choose the right strategy, and then manage that strategy appropriately, then hopefully you can turn that into making some good money for you. I sometimes get asked the question, what's the best options trade, or which is the one that works the best? And my answer is always, they work as advertised. So there are bullish, bearish, and neutral strategies. It's a matter of picking the right one to fit your market thesis and then managing that one appropriately. Let's see what else we have. Since implied volatility varies at different strikes, when we talk about annualized, do we take the aggregation of all the eyeballs from all the strikes, or just the at the money strikes? I may have to read that a few times, but I think I know where this is going. You have implied volatility levels at all of the different strikes. They're each annualized. So normally when you do see a singular number, this aggregation that the question is referring to of implied volatility, it is doing just that. You are taking put implieds and averaging them, or call implieds and averaging them. It is common to just see an expression of one implied volatility level for an entire term. And most often you actually might see that, as opposed to having to look at every single different strike. And when you do see that expression of, this particular expiration, this is the implied volatility there, hopefully wherever you're getting that information has some sort of explanation of how did they get that number? Where is that singular number coming from? And I would expect that it would be exactly as the question suggests. It would be aggregating all of the implied volatility levels across strikes, first looking at maybe puts. When I say looking at puts versus calls, what I mean is taking your out of the money puts and your out of the money calls. And those are the two numbers you get and aggregating them all together. Question is, don't you see the same implied vol in the call on premiums as you show in puts? Again, I'm going to try to interpret that as, would you see the same implied vol in calls and puts given strike prices? And the answer is yes. Generally speaking, yes. If you give a strike price, and you can calculate implied vol for an options price, call or put, but you would expect, given a certain strike price, that the implied volatility level that you see is going to be the same for calls and puts. And there could be deviations from that as you have different levels. Say when you have circumstances like dividends and you have put premiums and call premiums that might be looking at a little bit different underlying values for equity options where you have that early exercise feature. So I don't want to say this is a rule that always holds where you might see some deviations, but from as an educator, from a conceptual perspective, yes, call and put implied vols given a strike prices, given a certain strike price would be the same. We have a question here. How much would your suggested maximum loss when trading options be before you call it off? You know, for me, every trade is different. I get asked this question quite a bit when I speak for various firms, and everyone seems to have a different answer to this when they'll say, well, I look for 50% is about all I want to lose, or I start to look at the stock price. You can look at the stock price itself breaking a certain level, and when it does, your thesis is gone. I'm getting out of the options trade whenever that happens. So oftentimes you can use the stock price as your trigger for getting out of your options trade. But this, for me, every situation is different. If I spent a little bit of money on a cheap options contract, I may have went into that thinking, I'm going to let this one go and see if it works out, but I'm comfortable with that amount of loss. Oftentimes when you're trading at the money, or if you ever trade slightly in the money options and you're dealing with more premium, you might not want to lose the whole thing. So the question's a good one. I always answer this kind of question the same way. I look at this on a case-by-case basis. My confidence level is different every time I'm in a trade. My risk tolerance is also different. Remember, I'm managing my position against my market thesis, but also I'm managing money in my account. Sometimes I feel like I can take a little more risk. Sometimes I feel like I need a winning trade. Sometimes I feel like I can't afford to take a loss. Every situation is a little bit different. So what's the maximum loss? It's going to be up to you. I would say each trade is different. Each trade is unique. But if you want to develop a rule for yourself that you always adhere to, that's okay too. And this reminds me of my days spent as a day trader. I began trading futures, day trading futures, by looking at each trade individually and considering myself to have, well, I'll have a different risk tolerance on each trade depending on my confidence level. That was tough to do. That was hard to do because of the way the futures markets move. So I had to develop rules for myself that said, well, once I reach this level, I am out. And there's nothing wrong with having those kinds of rules for yourself. Question says, if the stock is 2 days before expiration, it is quite volatile because of implied vol. What is the best time to exit a bear call spread? A bear call spread involves selling options. It's a credit spread with 2 days to go before expiration. The answer here is going to greatly depend on the stock in relation to your strike prices. With only 2 days to go, if the options are out of the money, you certainly want to look to see how much more can I possibly make on this vertical spread. And you're saying implied vol might be high, so maybe there is a little bit of premium left. But with just a couple of days left, if you're out of the money, you're in a profitable position, there's likely not too much left there to gain, and there could be a whole lot to lose. So that risk reward tends to be skewed a bit unfavorably in that situation. That's when you would maybe consider and lean towards getting out of the position and moving on to another trade when you have much more to lose than you have left to gain. On the flip side of that, if the options are in the money, there's probably not much you can do about it. That trade is going to look like a losing trade, and your profitability is really just going to be dependent on where might the stock go over these next 2 days. And really the same answer if the stock is in between the strikes, with one slight difference. If the stock's in between the strikes, again, there's not much you can do managing your profitability there. You're susceptible to where is the stock going to go from here. But certainly, if you're in between strikes, you would want to feel the pressure to get out of at least your short call. Otherwise, potentially ending up with a short stock position that you don't want to have. So slightly different looks there with these vertical spreads, depending on where the stock sits with respect to your strike prices. Good questions, and I love the participation and the feedback. It's wonderful to see that and see we're bumping up against the time constraints here. So Gina, again, your audience is always wonderful. I enjoyed the presentation. I hope they enjoyed it as well. And I'll let you take us home.
Okay, great. Thank you, Ed. That was very interesting and informative, and we appreciate OIC's efforts in option education. And on behalf of eOption, we'd like to thank you for attending today. And if you'd like a recording of the webinar, it will be posted to our website later this week. And you'll also receive an email this week as well with a recording. And if you like the content today, we do have OIC strategy content on our website at eoption.com, where we have over 100 clickable links. And Ed mentioned a few terms such as straddle, strangle, iron condor, bear call spread. If you want to find out more about these, you can just go to eoption.com, click on education, and you'll see the links. And if you click on it, you'll see explanations, videos, and it'll give you some good insight in getting started on these strategies. We also have a catalog of past videos and webinars on our website and YouTube if you'd like to learn more. And also, if you're interested in actually trading, at eOption, we charge some of the lowest rates in the industry. Our stocks and ETFs are commission-free, zero, and options are 10 cents a contract plus $1.99 per trade. And we get many accolades offering some of the lowest rates with great services. So we encourage you to check us out. And if you want to mark your calendars for our next Option Tradings webinar, that's on Wednesday, December 16th at 1 p.m. Central Time. So in just about 2 weeks from tomorrow. And it's a fun one. It's called Year-End Holiday Option Strategies to Help Keep the Grinch Away. And it's hosted by a professional trader with over 30 years of trading experience. And make sure you like us on Facebook. You'll get advance notice of our webinars, market updates, and investment tips as well. And thank you again for attending. We appreciate you taking the time out of your day to spend it with us, and be safe. Thank you again. Bye now.